Hello and welcome to another episode of the Mark Moss Show. We're always talking about the decentralized revolution, talking about the way the world is changing, of course, through the lens of politics, finance, and technology. That technology is Bitcoin, the decentralized technology that's changing the world. And you know, I like to bring to you some different educations so you see the world differently, some late-breaking news headlines, and of course some guests so you can get some different perspectives than just hearing from me. And that's what I got for you right now. I am joined by Ansel Linder. He's the host of Bitcoin and Markets, the co-host of the Fed Watch with Bitcoin Magazine. And man, he has a wealth of information. I've been on his show before. I'm so happy to have him on. Ansel, thanks so much for joining me.
Thanks, Mark. Looking forward to this conversation.
Yeah, man. You know, I love talking to you, and I love seeing your research, you know. And I love talking about the macro picture and what's going on, you know, sort of speculating what's happening and what that all means, so to speak. And, you know, I know that you had just recently put out a report, so let's just jump right into that. And you had talked about some predictions for 2024 and some cycles, some market cycles. Now, I know that you wrote this, was it maybe about a month ago, I don't know, a few weeks ago maybe. There's probably been a lot that's changed in this last week. The markets are just really moving really fast, pretty volatile right now. So let's dig into some of that. People love predictions. So when did you write that report, first of all, and how much has changed since then? And is it going along with what you thought, or is it different, faster, or whatever?
Well, I think you might be talking about the first piece that I wrote for the BM Pro, Bitcoin Magazine Pro. Right. That was about 3 weeks ago.
A couple weeks ago.
Yeah, so my thesis is very different from most people. The big thing I'm trying to build out right now is the difference between inflation and recession. And in my mind, if we have higher inflation, that precludes having a recession, because higher inflation means we have growth and spending in the economy, which wouldn't be recessionary. So if I've been calling transitory inflation for a long time, and we have slowing inflation, most people are talking about recession. So I'm leaning towards the recession route. So now that I have that kind of general framework, I'd look at.
So let me try to understand. So if we have inflation, then we wouldn't have recession, and the reason why is because if we have inflation, so let's say that I sell, just so everyone, if I sell 10 iPhones at $1,000, then inflation pushes them up to 2,000. I still sell 10 iPhones. Now it's 2,000. So technically, we're not in a recession because the economy is growing. Right? That's
correct. And the way I define inflation is money printing. And so for money printing, you have to have an increase in credit, and you only get an increase in credit when you have an increase in economic activity. So they're mutually exclusive. You can't both have a slowdown and a speeding up in the economy.
Well, I don't know if that's necessary. I don't want to say that's not right. Let's just dig into that for a second. So let's just say hypothetically, I sell 10 iPhones for $1,000. Mm-hmm. But with inflation, the price goes up to 2,000. But now I only sell 8. So there's less economic activity, less goods being sold, but the gross value, the GDP of that number went up.
Yeah, that is a hypothetical, but we have to get from A to B. And so to get from A to B, you have to have actual money printing, or an expansion in the economy. So it is a hypothetical, and I agree with your hypothetical if that is the case. But the problem is
wouldn't we see that being the case? So, like, for example, like real estate sales, right? The price of real estate's up 50%. So we're not seeing more homes sold right now, but in real estate is probably a bad example, but the price of the new iPhone did just come out, right? And it's a lot more expensive than it was before. So then, yes, they could sell less iPhones and still produce more revenue.
Yeah, and that also brings up another part of my thesis, I guess, macro thesis, is that you can have deflation and inflation, and they won't necessarily cause the prices to move in the direction you think. So if we have iPhone that's more expensive right now, it could be because supply chains are not at their most efficient, right? And so that's a deflationary force, which causes prices to rise. So you can have deflation that causes prices to rise, actually, and inflation that causes prices to fall. So you can have credit creation out there, net credit creation in the economy. People will seek out more efficient supply chains, more efficient sources of raw materials, more efficient labor, and prices will fall even though money is being printed. the net money is going up. So it's very important when we talk about inflation and deflation to get away from talking about price movements.
Yeah.
So
I agree. I love that you set that in the very beginning, because I agree with you 100% on that. Inflation is when the money supply increases, like a balloon. We add volume of air, we inflate the balloon, and similar, we increase the currency units, we inflate the money supply as well. What happens with prices is a result of inflating the money supply, right? That's like the Austrian definition of that. Is that kind of how you see it?
yeah, Mises said that money printing or increasing the money supply will inevitably lead to higher prices. But he didn't necessarily detail out exactly how that happens. It might take a couple of years. You might have some deflationary forces first, then inflationary forces. But he and Rothbard and the Austrians, they described it as money supply. That's how I look at it as well.
Yeah, and as I do as well, right? And so over time, it doesn't happen right away, to your point, right? Over time, there's the equilibrium that's found. And so that increased money supply will push prices up, right? And you could argue, I've seen Michael Saylor argue that, well, actually government policies are inflationary as well. So a government policy could be restrictive, which then causes the business cost to go up, which then causes prices to go up. But if I look at that under the Austrian lens, well then that still evens out, because now that the cost went up, then I have to spend less in the economy somewhere else. And so that will eventually even itself out if no new currency units were added.
Correct. Yes. Yeah. And also prices could go up or profits could go down. So government regulation, it could either result in prices going up, like you say, or pinching profits, and those companies now not being able to service their debt or not being able to grow, and they maybe even go out of business. So those are deflationary forces as well.
Yeah, and I think it's important to understand, I want to hit this point real quick and then we'll jump back into your thesis, but trying to measure inflation as the money supply increase makes sense because we can measure that. Trying to measure inflation as prices going up is ridiculous because it affects all of us differently. So just in that example I gave, which is if government regulations push the costs up, well then we spend less somewhere else. We can have inflation somewhere and deflation somewhere else. And so then what am I buying? What are you buying? And so it affects us all differently. It's pretty hard to measure. But so going back to this, so then you're saying, so jump back to your thesis, you're thinking that because we're going to continue to have inflation, we won't have a recession?
No, I think we will have recession. I think we're going back into deflation. The overall if even from a further, another higher view of my theory is that with credit-based money, we're at the end of a long credit cycle, kind of like a Ray Dalio thesis where, we're going into the bust cycle. We had 75 years of expansionary credit, and now we're going on the downside of that. So, and I don't think we can get out of that by, you can't get out of a debt problem by adding more debt. So the end of this is deflation of some sort or another. And that's not very popular in Bitcoin land because obviously Bitcoin is an inflation hedge, but it's also a deflation hedge like gold is. So there's counterparty risk when you're talking about the credit system, and people will flee to safe and liquid assets. Gold will benefit, so will Bitcoin, and Bitcoin has obviously a lot more room to grow. So that's my general theory.
Wow, there's a lot to dig into there. Well, the first thing that I think about, and I always remind my audience, anytime I'm speaking at a conference or in a panel or something, I always kind of throw this out, is like the first question that you as a listener need to understand is over what time frame? Because like I could be saying bonds are the worst investment, you could say bonds are the best investment, and we seem like we're disagreeing, but we might actually agree. We're just thinking of different time frames. So I want to talk more about the time frame of that. And then I want to talk about the two types of bust, inflationary bust and deflationary bust. I'm curious what time frame you're thinking about this, and not trying to pick a date in a month, so to speak, but like, is this like months? Is this years? Or how do you see this sort of like playing out in that scenario? Like, do you think right now, like inflation has peaked? Like 9.1 was the peak last year, and it's only going down from there. Is it going to continue to have waves? Will it go higher before it goes lower, or kind of how are you thinking through that?
Well, I think going back to our last segment there, I think if you define inflation by money printing, I think the peak is in. If you define it by CPI, I think we could have some waves of higher CPI, not much higher, maybe we hit 5% again, but I think the overall trend is down. And yeah, you never want to pick a time and a price on things,
Right.
but I really think that the kind of stars are aligning to be a repeat of 2019 in 2024. So in 2019, Powell was pretty new to the Fed. They were hiking, then they paused in January. They paused all the way out to July, and then they had a first mid-cycle adjustment in July with a cut. If you look at the Fed funds futures market right now, that's where it's pricing in the first cut would be in July again. And then you get into seasonality where, I really am big into seasonality, and I think the end of Q3 is a big crunch time in credit markets and markets in general. So, that's the time frame I'm looking at. I kind of had a similar time frame for this year, but I was watching it, and with all my subscribers and stuff, I was every week I would update it, be like, okay, it's looking like less and less a chance of recession this year. Let's start looking at 2024. And now that's kind of the call is towards the second half of 2024. The economy is obviously in recession, probably an official recession from the MBER, and that's where we go.
Is now, you think?
What's that?
You think it's officially in a recession now?
No, I think it'll officially be going to recession the second half of next year.
Got it, yeah. Because it needs 2 quarters. I mean, Biden changed the definition, but technically we need kind of 2 quarters of negative growth, right?
Yeah, 2 quarters. There's some other things like with the labor market and a few other indicators that they have to take into account. But yeah, and
so it's sort of like a lagging indicator, right? It's sort of like unemployment, but it's like, hey, we just had 2 quarters of negative growth, so now we're in a recession. It's like, oh, thanks for telling us now.
Yeah, and one thing I've been saying too is that it'll feel like a recession. Like this 2023 definitely was painful for a lot of folks, but it wasn't an official recession, and I think that will be the same thing in the first half of the next year.
Do you think
Yeah.
when we had, we had 2 quarters of negative growth in the beginning of this year, the Biden administration said, well, technically it's not a recession. There was a lot of noise about that. Do you think that wasn't a recession, or do you think it was?
I think it was recessionary. I can go both ways on that. I understand the official definition, and I understand why they don't want to call it a recession because it's on their record. They don't want to put a recession on their record. So I understand that side, but I also understand the side where it feels. We had high inflation. People can't make ends meet. Gas prices were very high last year, and all that stuff. So I understand both sides of it. Yeah.
So I'm excited to dig into this with you, Ansel, just because I'm an inflation bull. I kind of see the opposite. So neither of us know. Neither of us have a crystal ball, but it's a fun conversation to have. So I'm sort of like this inflation bull where I think the world is much more inflationary. And to your point, are we looking at it in as far as prices, or are we looking at it in terms of money printing? And I think it's both. I think we have massive inflationary pressures because as the world continues to break apart, the cost of goods and services and labor is going to go up, I would think. If we continue to onshore things, we continue to have supply chain wars, that is inflationary on prices going up. But on the money supply side, to your point, you can't solve debt crisis with more debt, but you can try. And I don't see how a government goes goes bankrupt without using the money printers. I think eventually, this is why I say time frame. I think I would agree with you. And again, I don't know. So let's just talk about this. But I think eventually that's the case, but I think it's an inflationary bust before a deflationary bust. We got $1 trillion in stimulus in 2008. We got between monetary and fiscal about 10 trillion in 2020. And maybe it's 20 trillion in 2024, 2025. But you don't think they are going to fire up the money printers?
Well, I don't agree that that's really money printing. I think money is printed in the process of making a loan at a commercial bank. And everything that the government does, everything the Fed does, is kind of like window dressing. It doesn't really count as money printing. So this is a credit-based system. It's all about credit. It's all about rehypothecation of credit. I just had a piece last week, or a live stream last week, where I went through the collateral multiplier, where people have started doing research on how many times is a treasury actually rehypothecated, and it's about 6 or 7 times. So if you take 33 trillion treasuries, that means the treasury market is actually $220 trillion. So 8 trillion from the Fed or another 5 trillion from the government, it doesn't really make a big difference if that 20 trillion is shrinking, if there's contagion in the broader space. So that's what I would say. And also to push back on the deflation versus inflation. So you talked about like cost push inflation with the wages going up or the prices going higher. That also has an adverse effect on the credit markets. So when I look out into like maybe a geopolitical macro environment, I see deglobalization, I see depopulation in a lot of places with horrible demographics. People are aging in some major economies, right?
Yep.
And those are not beneficial towards credit markets. So
Right.
the credit is going to shrink. There's going to be a big anchor on this big credit financial system that we have, and that is overall deflationary. And it doesn't matter if they spend another 10 trillion next year or whatever. It's just pushing against the string,
Yeah, no, I agree. There's massive depopulation problem, China specifically, but all through the developed world, it's a big problem. I agree with you on that, and to your point on the cost push inflation. So you raise prices, is that deflationary? And these are complex issues.
Yeah.
I for sure when you have when you have rising population and rising credit, you get growth, and when you have the opposite of both of those, you get the opposite of growth. So that makes sense. I would say like on the credit side, though, you have that depopulation agenda, or not agenda, I shouldn't say. It's not an agenda. We're not talking about conspiracy stuff. We're just talking about demographics. That's decades, right? So, like, if I think about the next 4 or 5 years, I don't think that depopulation demographic really plays into the next couple of years. When you think about, like, credit, and you talk about, like, this Fed stimulus, the 10 trillion between the Fed and government. But let's talk about just from the Fed. A lot of that went to really taking a lot of debt onto their books. And if they take the debt onto their books, then those companies could then take on more debt. You're kind of talking it really from this Austrian lens, and so we want to make sure that we're clear on definitions. And I agree with the definition from an Austrian viewpoint of money, of the inflation of the money supply, which, to your point, we're in a debt-based monetary system, so that's increase of debt. And so I guess your main thesis is that you talked about the depopulation, and not from a conspiracy level, that's just demographics. I think that's like that really starts hitting 10 years, 20 years from now. So I don't think that's over the next 5 years. If we think about just the rest of this decade, so what is that, another 6-7 years? I don't see that being a big piece, but this debt bubble is a big piece. And so I guess even just from that level, well, one, would you agree with the demographic piece? Maybe not in the next 5-6 years. And then if so, then two, you think that we've sort of maxed out on credit for the next 5, 6, 7 years?
So touching on the demographics, I do agree that it will ramp up slowly. But there's countries like Japan and South Korea that...
Ramp up slowly meaning becoming more of a problem.
Yeah. Especially for...
Declining, population declining, not ramping up, but being more of a problem.
Correct. Yeah. The adverse effects will ramp up as we go over the next 10, 20 years. But places like Japan and South Korea, they are facing a demographic cliff in 5 years. And it's hard to kind of conceptualize, but one thing that I've written about it is that, network effects. So as you add people to a network, the benefit to each person in the network grows exponentially. Well, if you have a reverse network effect and you start losing people out of that network, the network benefit can drop dramatically. So really just a very small marginal change in the population growth is going to have a dramatic effect on economic activity. So I think it's underappreciated by most people out there, and maybe I'm an alarmist about depopulation or demographic decline, but I think that's a very big problem. And what was the second half of your question?
You're certainly not an alarmist. I mean, Harry Dent Jr. has been talking about this for a long time. He wrote a book called The Demographic Cliff I read years and years and years ago. Peter Zion talks about it a lot. Even Elon Musk is pounding the table that depopulation is a a big problem for us. So you're certainly not an alarmist, and I agree on those numbers. And one of the things when you understand demographics, I really learned this from Harry Dent's book, is that while we may all be different people and we're different cultures, our spending patterns are somewhat predictable as we move through life. And so even to your point of the credit creation or the credit contraction, as we get older, as we're retiring, we're just going to take on less debt. Like, I'm going to die in 10 years. What the heck am I going to go borrow a bunch of money for, so to speak, right? And so just that in itself, even those people might still be there, they're certainly not producing, so they're not in their production years, but they're also just not in their consumption years, and so they're not consuming a lot of debt. So certainly, I guess you could see the debt contraction happening from that aging population in those areas. You don't think that governments can pick up the slack? They sure seem like they want to borrow a lot of money.
You mean just like replace them with more money printing or something?
Yeah, well, I mean, California just went from a $100 billion surplus to a $60 billion deficit, just like that. So there's $60 billion of debt they need to pick up, which is way more than most of the old people in California, for example.
Yeah, and I don't know if it's which comes first, if it's a chicken or the egg, but I think that with the debt problem that we have in the world today, where there's just this gigantic credit bubble, unimaginable credit bubble in the world. Now, did that cause the demographic decline, or is the demographic decline going to cause a bursting of the bubble? Which comes first? But no, I think that the credit bubble is so far extended that if they print more money, you know the diminishing marginal returns, right? So
sure.
The more...
The diminishing returns is my base case as to why eventually we get the deflation.
Yeah, so the more debt that they print, you just get less and less in return for that. And I think we're there. And especially when you lock it in with deglobalization and depopulation, the end of the credit bubble is here. So I do see what you're saying that right before the end, there could be a spike of inflation. But for inflation, in my mind, we have to have increased, private sector credit creation, and we just don't have that.
Yeah. Does it have to be private credit creation?
Yeah, because I don't think the government spending money is actual money printing. I think the money is only printed when banks make loans. The government borrowing money, that money comes from somewhere first. It is coming from savings, so they're taking savings and spending it today. So it has an effect of increasing current demand, which pushes prices up. But the net amount of money hasn't changed. The net amount of money only changes when banks create loans to print money.
Yeah. And certainly we could see deflation happens fast, because all of a sudden just $100 billion could just disappear.
Yeah.
It takes a long time to build up $100 billion worth of debt, but it could just disappear instantly. Some of the things I think about, and you look about like the IMF making massive, multi-$100 billion loans to these nations. Now, what they do is they don't let these nations go bankrupt. They just let them, we'll just add more, we'll just add more, we'll just add more, so that debt never really seems to deflate. They just add another shrimp on the barbie, so to speak, right?
Yeah.
We see it happen in Argentina, for example. It is interesting that the three largest creditors to the IMF are Argentina, Ukraine, and Egypt. And if Ukraine were to lose the war, how are they going to pay the debt back? Argentina is facing some sort of like a revolution with potential candidate, Javier Milei down there. Maybe they don't want to pay back the IMF. Egypt has some serious debt problems going on. Like, what happens if those debts just go away? That's massive deflation right there. I think kind of to your point. Although, like I said, the IMF sort of has this history of not allowing that to happen. Now, the other thing I would say, though, is in 2020 we saw that the economy and the markets seem to have lost all relation. We had the entire global economy shut down, but yet markets were making new all-time highs. Yeah. So do you think the Fed could, we have like this massive potential deflation event with the commercial real estate mortgage back market, right? $2.92 trillion that could go away, 1 in 5 aren't paying, et cetera. But they could we'll just take all that on our books. We buy MBS anyway. Why not just take on all that on our books? Like, do you think the Fed has the firepower to sort of keep asset prices high, or no?
Yeah, I would call that a bailout. Like you're saying, the IMF would bail out these other countries, and they never let them go bust. They just keep bailing them out. Same thing on a more micro scale within segments of the economy. I think, though, that the problem with that is taking on someone's bad debt, like the Fed buying the MBS or whatever, that doesn't create a beneficial environment for the economy. It actually makes things worse when they do that, because I've explained it like this. So if you're in business and somebody you're doing business with gets a bailout, and you're going to question doing business with them, you might change your supplier to someone else. So it actually spreads contagion and stigma throughout the economy when you do these bailouts. That's why we didn't grow after QE the first time, after the great financial crisis. It was just not a recipe to get back on our feet. It's just a way to paper over the mess. So in total, it doesn't help the economy grow. And you have to have a growing economy to increase credit creation to then get a sustainable inflationary impact from that.
Yeah. So then if that plays out, so we get private credit decline. So from an Austrian viewpoint, we have deflation in the credit growth, or in the money supply, let's say. Then what happens? So now we're talking about that specifically as opposed to prices. Do you think that drives prices down, or could prices still go up in that environment?
Prices could still go up big time. Depends on what happens to supply. If businesses, manufacturers, supply chains start falling, collapsing, then you're going to have a huge cutback in supply. But for a time period, I don't know, 1 2 years, people will still want the same amount of stuff. So prices will go up. But that market has a way of correcting for that. So prices will go up, people will lose their disposable income, and then prices will have to come back down. So that's why the transitory nature. I think Powell knew this. I don't know if he understands the system the same way I do, but I think the reason why he called it transitory is because he saw that exact dynamic, that there is not a way to get sustainably higher prices because people just can't afford it. So it has to go up and come back down.
Yeah. One of the best ways that you've been able to protect yourself from inflation for thousands of years, inflation and deflation, has been gold. It's kind of the chaos hedge pillar. It's like an insurance for your portfolio. It's nice to have a little bit of that. A lot of people want to know where I've gotten my gold. And I work with a company called Universal Coin and Bullion. And gold's been doing pretty good since last October. It's up 16%. Silver's up 30%. Both have been working pretty well for your portfolio. And I work with Universal Coin and Bullion and Dr. Mike Fulgens because not only do they have great prices, which is nice, they're trustworthy. Dr. Mike has written the letters for the Texas State Attorney General on fraud prevention and so much more. And they have a very special offer for my listeners where you can get a silver 1-ounce American Silver Eagle coin with no dealer markup for just $27 each with a limit of 3. And you can even get free shipping and his award-winning gold investment guide if you mention my name, Mark Moss. The Silver Eagle coin is the most sought-after pure silver coin in the world, and you can get it for $27 by giving them a call, Universal Coin and Bullion, at 1-800-UCB-GOLD. Again, that's 1-800-UCB-GOLD. Or you can go online to universalcoin.com/Mark Moss. I think you make a very compelling case. I don't know, you don't know, but I think it is a very compelling case, and I do agree with your premise, and we do know. To your point, you talked about the law of diminishing returns, and something I talk about is what's called like the Keynesian multiplier. And so typically governments are trying to borrow 50 cents to get $1 worth of growth, but eventually the 50 cent gets them 80 cents and then 60 cents and then 50 cents, and eventually the 50 cents of debt gets them 20 cents of growth. And so typically that happens once you get over 90% debt to GP. Now we're well over 125, and so we're certainly there for sure. Now, you said that potentially we could have decreased deflation in the money supply because of credit contraction, but prices could still go up in the medium term because of that. Is that sort of like your base case for the next couple of years, or what is your base case for the next couple of years?
That was my base case going back 2021, 2022. So that part has kind of played out. I think we're sliding back into recession like we talked about at the beginning. I think 2024 we're going to see a recession. So what I would expect to see is very similar to the Great Financial Crisis or even 2019, where we have a peak in yields. I think that's kind of underway right now. So we have a peak in yields that they turn over for about 12 to 18 months before the official recession is declared. In the meantime, Stocks do very well. Bitcoin does very well. Bitcoin did very well in 2019 before the COVID recession. Stocks traditionally do what some of their best years are the years right preceding recession. So if we are into that time frame of being 12 to 18 months before recession, we should expect risk assets to rally. And taking it into Bitcoin land, the halving's coming up in that time. So I think this theory gives plenty of time for the halving to take its effect, to have the cycle through possibly the end of 2024, something like that. So my deflationary call does not take out any sort of idea of a Bitcoin rally.
So you think we have maybe a little short sort of price inflation, asset price inflation, sugar rush potentially before like the big kind of recession kicks in and then the big deflationary event happens?
Yep. If you look at the charts for the S&P 500 and compared to recessions, the year prior to recession is always very bullish. I think the average is like 30% returns or something in that year before a recession. So, of course, stocks then fall in recession. But, yeah, so if we're 12, 18 months out, I think we're looking good.
One thing I always like to draw attention to is that when you notice that Ansel and I have been talking about inflation being the money supply and through credit creation, not price inflation, as we typically talk about it in CPI. And so the reason why I want to bring this back up just real quick is because we all live on fiat currency and we use that as our unit of account. And so we're measuring everything in dollars. So how much is the S&P 500 worth, or how much is my house worth, or how much is Bitcoin worth in US dollars? But the US dollar is being manipulated all the time. And so it's not the best measuring stick because we don't want money. We want the things that money buys us, goods and services. And the reason why I bring that up is because everything is a trade. And so even though the US dollar value of Bitcoin could go down, or the US dollar value of gold could go down, it could still buy you more goods and services at the same time. And so what happens is you look at your portfolio, it's like, oh my gosh, it's down in US dollars terms, but it actually could buy you more of the food or the oil or the cars or the real estate that you want. Just like you could see the US dollar value of your gold or Bitcoin going up, and it could actually still buy you less of other things. So when you look at like a deflationary event and then you think about some of these stores of values, Ansel, do you think that might be sort of what we'd see? So even maybe the US dollar value goes down, but they're buying you more goods and services?
Yeah, I like the way you put that. So like, for example, we could just take commodity like oil, and yeah, gold, the price of gold or the price of Bitcoin might go down, but oil will go down more. So oil, you'll still be able to buy more of the commodities and probably more of goods and services with your gold or your Bitcoin for sure. Yeah.
Yeah, it'd be interesting. I don't know if I've looked at a gold oil chart, for example, to see how that's done. Have you ever looked at that before?
No, I haven't. I will do that right after this though, for sure.
Yeah, it'd be interesting to see WTI.
I mean, you can just think about gold has trended up, say from 2003 to today, and oil has after the Great Financial Crisis, it had a blow off top, and it has generally trended down since the Great Financial Crisis. So that would still hold even for that.
Yeah, I was at BitBlock Boom in August, and I was doing a panel with Tour de Mister and Preston Pish, and Tour was saying how what he does now is all his charts that he's looking at, he likes to price in commodities, CRB, instead of USD. To try to get like a better idea of what's going on. I thought that was pretty interesting. I started looking at some charts that way. And when you look at it that way, you see that the S&P 500 hasn't come back up to where you think it has since 2020. So it's pretty interesting if you take a look at it like that.
Definitely, I'll do that. It's very interesting to put other things as denominators. You know, we often look at the Bitcoin price in gold terms instead of USD terms, or also the S&P 500 in terms of gold or Bitcoin. So that's a good way to do it as well. But I'll have to check out CRB.
Yeah, I want to share this. Let's see if I can do this. Gold prices versus oil prices, the historical relationship. So oil being orange and gold being blue. So you can see here, like where even when gold goes down, it buys you more oil. Pretty interesting. So yeah, the thing is, I guess the point to take home here is that when you're only looking at your portfolio in U.S. dollar terms, you're not getting the full picture, and you're missing out on that. So the base case is potentially going into recession next year, a little sugar rush going into it, sort of like we saw in 2019. And then potentially hitting that recession, credit creation contraction. The one thing that, I think, when I read Harry Dent's books, and I think I've read 5 of them, and you have the Peter Schiffs, and you have these people, I believe their research is correct. They always fail to realize how many more tricks these central bankers have up their sleeve. One of the things I saw happen in Europe, more Europe, not really in the United States yet, but you had the government's guaranteeing loans. So what happens is, the Fed, the central banks can set monetary policy, but the banks still say, no, I don't want to lend the money out. And so we saw that happen. But they say, hey, the governments would guarantee the loans of the bank. So now you have no risk. If you loan the money out, you make money. If it defaults, we'll cover it. And that could really increase the credit growth, potentially, hypothetically, right? So even though you have depopulation, even though you have aging population that doesn't want to take as much debt, if all of a sudden the banks are just like, hey, come get as much debt as you want for almost free, and they don't care because they have no risk, that could offset it, right?
Yeah, it could. I'd have to look into the specific research about when they do things like that. But if you look at the senior loan officer survey that the Fed puts out, they go around and ask banks about if they're tightening lending standards or loosening lending standards. Typically, in bad economic times, they're tightening their lending standards no matter what.
Because they don't want to lose money.
Yeah, and also demand for loans goes down. So because people tighten their belt in recession and they don't want to take on more debt. So demand for loans goes down, and also lending standards go higher. I don't know how the loan guarantees would affect that dynamic. So, yeah.
All right, man. This is what a fun conversation. I really appreciate it. What a good point of view. I'd love to. We'll have to talk more for sure about this. If you're just tuning in, you're listening to the Mark Moss Show. I've been sitting down with Ansel Linder. He's the host of Bitcoin and Markets, the co-host of Fed Watch with Bitcoin Magazine. You certainly want to go check out his work. We'll link to it in the show notes down below. That's what we got. So much. That's what we got for today. Thanks so much for listening. Until next time.